guys. So in today's session we'll be discussing the chapter Indian financial system and money market. So before you listen to this lecture, I request you to read the chapter of money market from Shankar Ganesh. Okay, I have given the link for the purchase of book in the description, and I request you that since I am outside, please bear with me the background noises. Uh, so with that, we'll start our chapter. I have only included the main points that you need to know. Okay, it is better that you read the chapter first before listening to the lecture. Okay, money market refers to the market for borrowing and lending of short term funds, say up to 3 years. The deposit and withdrawal of money also forms a part of the money market. Capital market, so that is money market. So capital market is a market for borrowing and lending of medium and short term funds, say above 3 years. The market to raise investment also forms part of the capital market. So capital market includes the stock exchanges, development financial institutions form the, and they also form the capital markets. Okay, now we will see Reserve Bank and its function. Another important thing. Okay, it is called the central bank. It is called the central bank and was established in 1935 under RBI Act of 1934. The RBI Act was on 1934, but it was established on 1935. Okay, general superintendence and direction was carried by the Central Board of Directors. Apart from the central board, RBI has 4 local boards. So local boards are in Chennai, Mumbai, Calcutta and New Delhi. Okay, now what are the basic functions of RBI? The basic functions of RBI, it is to regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India, and generally to operate currency and credit system of the country to its advantage. Okay, basically it stabilizes. When we discussed inflation and deflation, we saw how RBI regulates the inflation and deflation in the country. Okay, like that, the RBI functions as a controlling body. So these are basically the functions of RBI. First one, it's a note issuing agency. That is another color. It's a note issuing agency. It's called the Bankers Bank. It manages price stability. It manages exchange rate currency. Then controller of credit, and also the lender of last resort, banker to the government. Okay, these are some of the functions, and we will be discussing the main functions in the coming sessions. Okay, now what is a monetary policy? Monetary policy, issue of money is the exclusive right of RBI. All notes except 1 rupee note and coins are issued by RBI. So who issues this 1 rupee note? 1 rupee note and coins are issued by the Ministry of Finance, but they are circulated by the RBI. Okay, RBI keeps 115 crore in gold and rupees 85 crore in foreign securities as backup. This is called minimum reserve system. It is 115 crore in gold and 85 crore in foreign securities. It is taken as a minimum reserve system and has been followed since 1957. Okay, RBI ensures that the issue of new currency does not lead to inflation. In the chapter of inflation, we have seen what are causes can lead to inflation, and one of the causes is issuance of more amount of money, more amount of currency in circulation, which increases purchasing power. Okay, which increases the demand, which in turn increases the prices of the product. You have seen that. So RBI ensures that the issuance of new currency does not lead to inflation. Okay, banker and debt manager of the government. RBI acts as a banker to both the center and the state government, except for Sikkim. It's an exception. So whenever in UPSC, when you see an exceptional case, mark it important. So this can be asked as a question. Maybe along with Sikkim, it can ask Manipur, Mizoram or some other states also. The question can be, RBI acts as a banker in the case of, it does not act as a banker for Sikkim, Mizoram and Nagaland. Okay, but if that kind of question comes, it is a wrong statement, because in the case of RBI, it only is an act for Sikkim. In the rest states, it is applicable. Okay, RBI carries out lending and borrowing operations by issuing government securities on behalf of the government. RBI is not the banker to Sikkim and Jammu and Kashmir. Okay, Sikkim and Jammu and Kashmir, but in the case of Jammu and Kashmir, it's not there at the moment. Okay, it manages public debt to some extent. Okay, now Bankers Bank. Bankers Bank, it keeps the reserves of bank like cash reserve ratio. No need to worry, we will see what is cash reserve ratio in the coming sessions. It keeps the reserves of banks with like the cash reserve ratio with it. It provides financial assistance to banks against mortgage securities and rediscounts bills of exchange. As RBI provides enough money to banks, it is called the lender of last resort. Controller of credit. It refers to control of lending and deposit creating capacity of the banks. It is essential to control inflation and thereby promote economic growth because both parties depend on the money supply. Now, what is base rate? Base rate is the minimum rate below which banks cannot lend. Okay, lend means giving it out as loans. There should be some certain amount of interest rate, right? That minimum amount is called base rate. Okay, now quantitative methods. Quantitative methods. It aims at controlling the cost and quantity of credit. It does not discriminate between different sectors and end use of credit. Now, conventional measures. Conventional measures. Bill of exchange denotes a written document that assures payment of money by purchaser to seller for the goods purchased at a future date. That is bill of exchange. Now we have the discount rate policy. Discount here implies that the process of converting a bill into money at an earlier date than that is mentioned in a bill of exchange. Okay, the discount is carried if the receiver of the bill exchange needs money urgently. So we have, according to the bill of exchange, say we are giving it the 11th of December. What happened? The discount here implies the process of converting a bill into the money at an earlier date. Okay, so we are planning to give the money back on 5th of December. Okay, then the receiver of the bill, there should be a reduction, right? Okay, and the discount is carried if the receiver of the bill in exchange needs money. So there is a urgency in the money. In this process, the receiver can approach a bank. The bank accepts the bill of exchange and pays it. For that, it deducts some percentage of the money as interest. The bank will receive full amount from the purchaser on the maturity date. Otherwise, the bank will convert this into money at a lesser discount rate from RBI. For example, now we come to the example. For example, at 6% and will receive rupees 940. The profit of the bank is 20. This is called rediscount. This rate is called bank rate or discount rate. Apart from bills of exchange, the commercial banks get their government securities discounted from RBI. Okay, just know what is base rate, just know what is discount rate. Discount rate is basically the reduction that the RBI provides or that the bank provides for the bill of exchange when it is given out earlier. Now, open market operations. Okay, this method refers to the sale and purchase of securities, bills and bonds of the government as well as private financial institutions by the central bank. The financial instruments like securities, bills and bonds are written documents that are issued to banks and public against money given by them. If the central bank sells these instruments, banks and public will buy it and pay money to the central bank. If central bank buys these instruments from the instrument holders, it will pay money to the instrument holders. Okay, it's like buying and selling of securities and bonds and government bonds and all that things. That is called open market operations. It can involve private institutions also. Okay. Now, through buying of financial instruments, the money supply is increased. The banks will have more money with them. The public who sold will deposit the money with the banks. So, the resource of banks increases, which in turn helps to increase their lending capacity. When there is more money supply, the interest will come down. Therefore, more people will borrow from banks. The reverse is in the case when the central bank sells financial instruments. So, this is very important point. Okay, what will happen when the central bank sells financial instruments? The money supply will decrease, and which in turn will lead to the increase in the interest rate, which implies that lesser people will take loan. Okay, just note it down. Okay, variable reserve ratio. In these methods, the reserves that scheduled banks have to maintain are varied to control the credit creation. Scheduled banks are required to keep a certain percentage of their net time and demand deposits with RBI under RBI Act of 1934 can be shown in formula. Okay, the cash. So this is a basic formula of cash reserve ratio. Cash reserve by net time and demand deposits into 100. So why this need of variable reserve ratio? This is aimed to have control over banks' credit. The ratio was 3 to 15 percentage. Within this range, RBI fixed the CRR, that is cash reserve ratio. If this ratio is increased, the banks have to deposit more money with RBI, so the resources available to the banks for lending will come down. It will decrease. Okay. The reverse is in the case and the ratio is decreased. As per RBI bill of 2006, the floor and ceiling condition are 3 to 15 percentage was removed. Okay. Now SLR. SLR is basically statutory liquidity ratio. Scheduled banks are required to keep a certain percentage of their net time and demand deposits in their vault itself. Okay. It needs to be deposited with RBI. This reserve is a precautionary measure. It prevents banks from lending all its deposits, which is too risky. It is mandatory under Banking Regulation Act of 1949. This ratio is 25 to 40 percentage of time and demand deposits. This reserve was kept in the form of cash, gold, and bond. As in the case of CRR, this reserve is varied to control the credit. Now the floor and ceiling are 25 to 40 has been removed. In the case of SLR, it is kept by the bank itself. Okay, it is kept by the bank itself. But in the case of CRR, it is kept by RBI. And also in the cases of CRR, it is kept in the form of cash only and too with the RBI. Okay, but in the case of SLR, it can be kept as cash or gold in such means within the bank itself. Okay, the bank should hold it to itself. Okay, now liquidity adjustment facility LAF. It is a short term credit control measure. It is to absorb the excess liquidity. The extra amount of money in circulation needs to be controlled, right? So we use LAF. It has two instruments, namely repo rate and reverse repo. Okay, repo rate. It is the rate at which the commercial banks borrow money from RBI by mortgaging their dated government securities and treasury bills. Okay, if the repo rate is increased, the banks have two options, either to reduce the borrowing from RBI or borrow at a higher rate from RBI. Just like the people borrow from the bank, the same way the banks also borrow money from RBI. Okay, so the interest rate at which the banks borrow from RBI is called repo rate. Okay, if banks borrow fewer amounts, the credit creating capacity of banks will come down and money supply will come down. If a bank borrows and charges a higher interest rate, the customer will borrow less. The money supply will come down. If the banks borrow and charge higher interest rates, the customer will borrow less. The money supply will come down. If the repo rate is decreased, the reverse will be the case. Okay, just go through it because repo rate is a very important instrument. Okay. Now, reverse repo rate is just the opposite. Okay, it is a rate at which the RBI borrows from commercial banks by mortgaging its dated. In both the cases, the collateral is the government securities and treasury bills. Okay, if reverse repo rate is increased, the banks have two options, either to lend to RBI or lend to customers at a higher rate. If banks lend to RBI, the money available with the bank to lend to the customer will come down. The credit creating capacity of banks and money supply will come down. If banks raise the interest rate on loans, to the customers at a higher rate, the customers will borrow a lesser amount. So money supply will come down. It is very important that you need to know repo rate and reverse repo rate so as to understand how RBI controls the liquidity in the market. Okay, so with that I conclude the chapter on money market. I hope today's session was productive for you guys. So until next time we meet again, God bless you all. Jai Hind.